I want to talk about stock splits, stock dividends, and stock repurchases. Now, these fall under the general heading of distribution policy, which you'll find in most standard corporate finance texts. Now, in the case of a stock split, the firm increases the number of shares outstanding by redeeming old shares and replacing them with a larger number of new shares. For example, let's take a 2-for-1 split. This causes the number of shares to double, but the price to fall in half. Companies may choose to split their stock to keep the price of the stock from getting too high, which keeps small investors from being able to afford them. If you look at Berkshire Hathaway, the company that Warren Buffett runs, they've never split their stock, and as of this recording, the stock price is north of $300,000 a share, which makes it unaffordable for even fairly well-to-do investors. That's a lot of money for people to come up with to buy one share of a stock. In practice, it doesn't make much difference because most of the purchases of stocks are done by mutual funds and pension funds, and they buy millions of dollars worth of shares, so they don't really care if they're buying shares at $300,000 a share or buying a lot more shares at $30 a share. It doesn't really make any difference to them. As an example of how this works, suppose you own 100 shares of a stock selling for $50 per share. After a 2-for-1 split, you now have 200 shares selling for $25 per share. So in both cases, the value of your stock holdings is $5,000. You might think of a 2-for-1 split as taking a $20 bill and exchanging it for 2 10s. That would be a 2-for-1 split. A 4-for-1 split would be taking your $20 bill and exchanging it for 4 $5 bills. You can also have a reverse split. So this is the opposite of a stock split, where a firm will redeem old shares and replace them with a lesser number of new shares. So for example, suppose you have 100 shares of a stock selling for $50 a share. If there's a 2-for-5 split, so for every 5 shares you receive 2, you'll now have 40 shares valued at $125 per share. So this may be a way to bump up the value of the stock. If you had a stock that was selling for $5 a share, doesn't look good, looks like it's so inexpensive the company's not any good, you could do a reverse split and get it up to $20 or $30 or $40 a share. A stock dividend is the case where the firm increases the number of shares in lieu of a cash dividend. When we think of dividends, usually we think of a company sending a shareholder a check for $3 per share in a cash dividend. Here, instead of sending you cash, they increase the number of shares you own. So for example, if it's a 10% stock dividend, someone who owns 100 shares will get an additional 10 shares. And like a stock split, the price should adjust to keep the value of a person's holdings the same. So for example, if you own 100 shares of a stock selling for $50 per share or $5,000 worth of stock, if there's a 10% dividend, you'll now have 110 shares of stock selling for $45.45 and some change. It's kind of a repeating decimal. But there should be no change in the value of your holdings. It should still be $5,000. Now, in the case of stock splits and stock dividends, they simply cut the pie into smaller pieces, but they don't actually increase the size of the pie. Sometimes you'll see stock prices rise after the announcement of a split or a stock dividend, but that's not because of the split or the dividend. That's because it may convey information about the future prospects of the firm. If a firm tends to split its stock when it thinks that earnings will be growing in the future, then that is a reason for the price to go up, and people have actually studied this. Let's take a look at an example of how this works. So here we have ABC Corporation, and the value of their operations is $1,937.50. These are all in millions, but let me just use the numbers that are here. You can figure out the value of the operations by taking the present value of the free cash flows of the firm. Let's also assume they have $50 in short-term investments, $387.50 in debt, and 100 shares. So let's look at what happens before and after a $50 million dividend distribution. So before, the firm has value of operations of $1937.50. They have short-term investments of $50. So you add these together, that's the total value of the firm, $1987.50. Subtract out their debt of $387.50, and you get the total value of the stock is $1,600. Divide it by the number of shares, you get $16 a share. After the dividend, they still have the $1937.50 in the value of operations. Now they don't have any short-term investments because they used this money to pay the dividend. The total value of the firm is now $1937.50 minus $387.50, same amount of debt. The value of the firm is now $15.50 divided by the 100 shares. It's $15.50 a share, but shareholders receive a 50-cent dividend, so the total value here equals the $16. Okay, this is in the absence of taxes. If there were taxes, this isn't necessarily going to be exactly the same. Now let's take a look at a slightly different type of distribution policy, what's known as a stock repurchase. So here, the firm buys back shares from shareholders. And there's several reasons for repurchases. It's an alternative to distributing cash dividends. And that can be good because dividends are taxed when you receive them. Okay? Capital gains are not. So some investors in the firm stock may prefer just to have shares repurchased, and we'll find that and there are less shares out there, and they'll be entitled to a greater portion of the earnings of the firm because there are less shares outstanding. It may be a way to dispose of a one-time cash from an asset sale. So they may sell off a factory and they have some cash and they want to use it to repurchase shares. Okay, they may want to change their capital structure, right? They don't want to have as much equity. They want to have perhaps less equity and more debt. They may want to do it to obtain the shares when employees exercise stock options. So oftentimes employees, as a part of their compensation package, get the right to buy shares of stock at some pre-specified price. And if they choose to exercise those options, that is to take on those shares, the firm needs those shares to distribute to them. And you'll find firms will repurchase shares when they believe their shares are undervalued. So if the shares are selling for $100 a share and they think that the stock is worth $110, it's a good chance for them to buy back some of their shares. Now the earnings the firm generates will be divided amongst a smaller number of shares, and that'll raise earnings per share. So there are three ways to do the purchase. They can just have a broker or trustee purchase on the open market, the same way you would, right? You go to your E-Trade account or your Schwab account, and you just purchase shares of the stock. They can make a tender offer to shareholders. That is, they can say, we're looking to buy back a certain number of shares at this price, and anybody who's interested, any shareholders that are interested, can tender their shares back to the firm. Or they can target some large repurchases. So make a large block purchase, okay, purchase a large amount, say from a mutual fund or from a pension fund. And keep in mind, the firm does not have to complete its announced intent to repurchase. So, they might say they're going to repurchase a certain amount, and they may repurchase less. Turns out that repurchasing shares does not impact price. When a company repurchases shares, the price of the shares will not change. Intuitively, it's because the firm converts its short-term investments into shares of stock. This will reduce the value of the firm, but will also reduce the number of shares so that shareholders will get a larger slice of a smaller pie. Also, if the price rose before the repurchase, obviously investors would purchase shares prior to the repurchase and reap the benefits. So let's see how you calculate the number of shares that are repurchased. So the number of shares repurchased obviously equals the number prior to the repurchase minus the number post-repurchase or after the repurchase. You can figure this out by saying, let's take the cash that they used to repurchase divided by the prior price. These are both number of shares repurchased. You can set these two equal to each other, and so you get number prior minus number post equals cash repurchase divided by price prior, right? And add number of shares. Let's see, we'll do some rearranging here. We'll bring this to this side and this to this side. So the number of shares after the repurchase equal the number of shares prior minus the cash used to repurchase divided by the price prior. So from the previous dividend example we had, remember we had $50 in short-term investments, price was $16 a share. It turns out that they buy back 3.125 shares, and so the number of shares after the repurchase is 96.875. So let's see how that looks again with the same table. So this is the original table we had. So here, the $50 in short-term investments is used to repurchase the shares. Right here we got to the $15.50, right? But we know we now have less shares, right? We now only have 96.875 shares for the $1,550 that the stock is worth, which makes it worth $16 a share, right? This 3.125 shares is what we bought with the $50, right? Which we saw from the previous slide. So a little summary. Short-term investments fall because they are used to repurchase the stock. The stock price is unchanged by the actual repurchase. The value of equity falls from $1,600 to $1,550 because the firm no longer owns the short-term investments, but the wealth of shareholders remains at $1,600 because shareholders now directly own $50 that was previously held by the firm in short-term investments. So a little comparison of repurchase versus dividends. In the case of a repurchase, the stock price doesn't fall at the time of repurchase. The number of shares falls. When we have a dividend distribution, okay, a cash distribution, the stock price falls by the amount of the dividend at the time of the ex-dividend date. That's the date when you won't receive the dividend if you buy the stock. Here, the number of shares doesn't change, but the price changes. So again, it's a little bit of the difference between the two of these. Very common to find these under the heading of distribution policy in your standard corporate finance text.